But the market is a living system. Even in a strong move, it can throw a correction. I compare this to lab work. When a reaction changes speed, you don't pretend nothing has happened. You look at the readings and adjust the conditions. In trading, price is the reading. Candles are the observation, and discipline is controlling the conditions of the experiment. All right, friends, let's start with a simple thought. In crypto, most people lose not because the market is complicated, but because of how they react to the very first swings. It moves slightly against them, and they either rush to win it back or they start changing their logic on the fly, like the market is supposed to adjust to their expectations. My name is Aaron, and my approach is always the same. Trading is a process, not an emotion. Like in science, if an experiment doesn't confirm a hypothesis, you don't get mad at the equipment. You record the result, look at the conditions, and keep going by the protocol. Today we've got a short but very telling series on BNB USDT on the 1-minute chart. There will be a clean win, a normal working loss, and most importantly, how to adapt calmly without breaking the plan and without turning one setback into a chain of mistakes. We're working on the iFinX platform. Candlesticks chart, everything is really clear. If you like this format, calm, straight to the point, with the logic explained, subscribe, hit like, and check my Telegram, link in the description. I post checklists, a journal template, and rules that genuinely keep your head cool. Let's go to the screen. All right, we're on the iFinX platform. Chart type is candlesticks. On the 1-minute chart, candles give the most honest picture. Momentum, wicks, slowdowns, and where control starts shifting from one side to the other. I open the asset list and choose BNB USDT. Payout is 95%. For short trades, this is an important parameter. The payout directly affects the series math. Next, I set the time frame to 1 minute. On the 1-minute chart, you can't fall in love with the direction. You have to read what the market is doing right now and make decisions based on facts. Let's start trading. Trade number 1, short entry with the momentum. I start with $100 and enter down. Why down? The market is showing strong seller pressure. The move develops consistently without sharp corrections, meaning there's no situation where price keeps shooting up and shaking your confidence. Instead, the candles form in a way that clearly shows sellers control in the tempo. This is the moment where you don't need to invent reversals. If there's a clear impulse, it's smarter to go with it. The entry is taken in the direction of the current move. No rushing, no guessing, waiting. The trade closes confidently in profit. $195. Good, we lock it in and move on. Here's the key rule. A win doesn't mean the market now has to keep behaving the same way. So every next action is again based on confirmation. All right, trade number 2, another short and a normal loss. Next, I increase the amount to $150 and enter down again. The logic is clear. If the bearish impulse is still there, you can keep working in the same direction. But the market is a living system. Even in a strong move, it can throw a correction. Yeah, and that's what exactly happens here. The market gives an upward corrective move. Sellers temporarily lose control and the scenario doesn't play out like we expected. Price starts rising, the move slows down, and the trade closes in a loss. This is an important psychological point. A loss isn't a personal failure. It's part of the process. Even if the entry logic was fine, the market has the right to do what it needs to do. Grab liquidity, pull back, change the pace. What matters is what you do after the loss. And here we don't put on a show. We don't increase risk out of anger. We don't rewrite the rules mid-session. We just evaluate. What is the market showing right now? All right, trade number 3, recovery long on buyer confirmation. After that, I recover the same amount, $150, and enter up. Why up? Because buyers confirm they're here. Price builds an upward impulse. Candles form confidently without strong lower wicks. That's an important detail. When an up move is real, candles often look clean, without consistent dips that instantly get bought back. The market isn't nervous, it's moving. That's why a long entry here makes sense. The correction isn't just a random poke, it's a move where buyers are actually taking control. Waiting. The trade closes in profit, $292.50. This is what adaptation looks like. No arguing, no emotions, just switching to where the strength is showing up right now. Okay, trade number 4. Back to sellers after the correction ends. Then I increase the size to $200 and enter down. Now you can see the correction is finishing. The market returns to the previous direction and seller pressure strengthens again, meaning the buy impulse fades and sellers start controlling the move again. Here's what matters. I'm entering on confirmed movement, not hoping. We can see sellers are back and the move down becomes consistent again. Waiting. Okay, the result. The trade is green, $390. That's the calm style. Don't guess, act when the market confirms. Trade number 5. Final long entry, no rushing. After that, I increase the amount to $250 and enter up. Here's the nuance. This isn't chaotic flipping up and down. This is reading structure on the 1-minute chart. The market gives a solid pullback up, momentum develops smoothly and without sharp spikes. It doesn't feel like a random needle. It's a normal pullback, and the market often gives even inside a bearish structure. This entry is measured final step. No rushing, no emotion, no trying to beat the market. I can see the pullback is clean, so I take the move. The trade closes in profit, $487.50. Series result, total balance, 1,215. Now the most valuable part, what this stretch actually shows. First, losses are part of the process, not a reason to break the system. The loss happened not because everything is bad, but because the market pulled back. That's normal. Second, the result doesn't come from an ideal signal, but from three things. Discipline, not rushing and jumping into trades without a reason. Adaptation, switching sides when the market really changes phase. Decision control, every action must have an explanation, not an emotion. And third, notice the rhythm. There are no 20 trades in a row, no overload. It's a short series of actions where you ask yourself one question every time. Who is controlling the move right now? If it's sellers, I don't fight it. If it's buyers, I don't get stubborn. If the market goes quiet, I'd rather wait. I compare this to lab work. When a reaction changes speed, you don't pretend nothing has happened, you look at the readings and adjust the conditions. In trading, price is the reading. Candles are the observation, and discipline is controlling the conditions of the experiment. Friends, in short, this example shows that profit isn't luck, it's the sum of good decisions. Sometimes the market gives you a win, sometimes it gives you a loss. The only question is what you do next. Lose it or keep going by the plan. Remember, consistency is built on calm. Calm is built on a protocol. And a protocol is built on the habit of explaining every trade, not justifying it after the fact. If you want, I'll leave a simple checklist in my Telegram for series like this. Impulse, correction, confirmation, entry, lock-in. And a short journal template so you're not keeping everything in your head. Link in the description. Subscribe, hit like, and I'll see you in the next breakdown on iFinX.